Hey everyone, today we're diving into investing in 2026, and I want to break this down in a way that actually makes sense. People keep asking the same questions. Are stocks too expensive right now? Did we already miss gold and silver? And what about Bitcoin? Are we late to the party? These are fair concerns, but to answer them properly, we need to zoom out and look at the bigger picture instead of individual price charts. The first thing we need to talk about is liquidity. In simple terms, liquidity is how much money is flowing through the financial system and how easily that money can be accessed. When liquidity is tight, borrowing becomes expensive, lending slows down, and asset prices struggle. When liquidity is abundant, borrowing gets cheaper, money moves faster, and asset prices, stocks, gold, silver, and even crypto tend to rise together. A good way to think about liquidity is like a swimming pool. When the water level rises, everything floating in the pool rises with it. When the water drains, everything sinks. Right now, that water level is rising again. A lot of people are confused because they're seeing a weak economy alongside high asset prices, and that feels contradictory. But markets don't move on feelings. They move on access to money. When liquidity increases, money doesn't just sit in cash. It looks for returns. Investors start moving capital into stocks, ETFs, real assets like gold and silver, and increasingly into cryptocurrencies like Bitcoin and Ethereum. Gold and silver have always played this role because their supply is limited and they don't depend on corporate earnings. Bitcoin fits into a similar category in the modern system: limited supply, scarcity, and strong demand when money becomes easier. This is why focusing only on whether prices look high misses the point. Prices don't move in isolation. They move based on how much money is chasing them. And right now, more money is coming back into the system. The next piece of the puzzle is interest rates. The Federal Reserve controls short-term rates, and those rates influence almost everything in the economy. When rates are high, borrowing becomes expensive, risk-taking slows down, and future profits are valued less. When rates fall, borrowing gets cheaper, investors take more risk, and asset prices tend to rise as future earnings are discounted at lower rates. When the Fed cuts rates, cash starts paying less. That pushes investors to look elsewhere for returns. Some of that money flows into stocks, some into real estate, some into gold and silver, and some into crypto. Historically, Bitcoin has performed well during periods of easy money, especially when investors are more willing to take risk. Heading into 2026, we're moving away from a tightening cycle and into an easing cycle. The Fed has already restarted balance sheet expansion about $40 billion per month starting in December. They may call it reserve management or use other technical terms, but functionally, it's money creation. And markets don't care what it's called. They care that liquidity is increasing. When liquidity increases, asset prices usually respond. Stocks benefit from lower borrowing costs and higher valuations. Gold and silver benefit because they are finite assets priced in dollars that are becoming less scarce. Bitcoin benefits because its supply is fixed and more dollars are chasing the same number of coins. This is why you often see multiple asset classes rising at the same time. It's not because everything suddenly became better, it's because the underlying monetary conditions changed. Once you understand that, a lot of market behavior starts to make more sense. Instead of asking whether one asset is too expensive, a better question is whether the monetary environment is supportive or restrictive. Right now, the environment is becoming supportive again, and that matters far more than short-term price levels. Another critical factor is the US dollar. When interest rates fall and the money supply expands, holding dollars becomes less attractive. The purchasing power of each dollar slowly declines, which means it takes more dollars to buy the same real assets. That's why commodities, precious metals, and even Bitcoin often rise during these periods. Dollar weakness isn't accidental. It's often a feature, not a bug. A very strong dollar tightens financial conditions globally and slows growth. A weaker dollar makes debt easier to manage, supports exports, and encourages capital to move into assets. You can think of it as a release valve that takes pressure off the system. This ties directly into the idea of the Fed put. When major stress hits the system, like in 2008 or 2020, the Fed steps in. They cut rates, inject liquidity, and expand their balance sheet. They don't prevent volatility entirely, but they do prevent systemic collapse. That safety net matters because today's system is more interconnected than ever. Debt levels are higher, markets move faster, and problems spread quickly. If liquidity dries up, the ripple effects hit employment, housing, consumer spending, and government finances. So when stress appears, central banks are forced to respond. Gold and silver tend to benefit in these moments because they are tangible stores of value. Bitcoin, while more volatile, often benefits indirectly as liquidity flows back into the system and investors regain risk appetite. Different assets react differently, but they're all influenced by the same monetary forces. Understanding this helps explain why big drawdowns often lead to aggressive policy responses and why long-term investors pay more attention to liquidity than headlines. Looking ahead, one important milestone is May 2026, when a new Fed chair steps in. Historically, leadership changes often come with easier policy, at least in the early phase, as pressure builds to support growth and stabilize markets. There's usually pressure to keep asset prices from falling too sharply, especially with elections and political cycles in the background. When you combine falling rates, rising liquidity, a weaker dollar, and a central bank ready to intervene, you get an environment that tends to support asset prices. That includes stocks, gold, silver, and crypto. This doesn't mean prices go straight up. Volatility is guaranteed. Pullbacks will happen, corrections will happen, but in liquidity-rich environments, those pullbacks tend to get bought. That's why my approach for 2026 is simple. Stay invested, don't panic during dips, and let the macro tailwinds do their job. Gold and silver play an important role here because they don't depend on earnings or growth narratives. They've held value for thousands of years and act as long-term purchasing power anchors. Bitcoin fits into the picture differently, but it's increasingly behaving like a digital version of that same idea: scarcity in a world where money is constantly being created. Stocks, meanwhile, benefit from cheaper capital and higher valuations. A lot of people ask how high markets can go, but the more useful question is how long liquidity continues. As long as money keeps flowing and rates stay supportive, prices can stay elevated. The goal isn't to predict exact tops or bottoms. It's to understand the system you're investing in. And in that system, liquidity is still the dominant force. So the big takeaway for 2026 is this: don't get trapped by short-term fear or the idea that you've missed everything. Focus on the macro forces underneath the market. Liquidity, interest rates, the dollar, and central bank behavior matter more than almost anything else. Gold and silver remain important because they protect purchasing power over time. Bitcoin adds a modern scarcity asset to the mix. Stocks benefit from the same conditions through cheaper borrowing and higher valuations. Different tools, same environment, the strategy isn't complicated. Stay diversified, expect volatility, buy dips instead of fearing them. Understand that markets move in cycles driven by money, not emotions or headlines. 2026 isn't about guessing the perfect entry. It's about positioning yourself correctly in a system that's still being supported from the top down. If you understand that, you're already ahead of most people. Thanks for watching, and here's to making smart, informed investment decisions going forward.